In the high-stakes world of corporate finance, timing isn't just a suggestion. It's pretty much everything. Billions of dollars can move based on a single report. So what happens when a company misses the most important deadline of the entire year?
Right. What actually happens when a huge global company basically tells the market, sorry, our homework's late? Well, today, we're going to play detective and investigate Wall Street's least favorite excuse by breaking down some really fascinating research on this exact topic. And here it is. This is the key piece of evidence in our whole investigation. Form NT12B25. Think of it as the official corporate late slip. It's what a company has to file with the SEC when their annual report isn't ready, and it's their one big chance to explain why. Now, on the surface, the process seems pretty straightforward. A company misses its big annual report deadline, they file that late slip form within one business day, and boom, they get an automatic 15-day grace period. Simple, right? Well, not so fast. The real story isn't in the how, it's in the why. And this is where our source material gets really interesting. Researchers decided to basically become financial detectives. They gathered up 290 of these late slips filed by foreign companies that are listed in the US, and they started analyzing all the excuses to figure out what was really going on behind the scenes. And here is our first big clue from their investigation. When they sorted the excuses into categories, a massive 44% were just unspecified. Super vague. Another 35% blamed accounting issues, 12% pointed to things like mergers, and the rest listed a mix of reasons. Now, that huge unspecified slice of the pie, that's a mystery we are definitely coming back to. But first, let's zoom in on that 35% that did give a concrete reason, accounting problems. Because this, it turns out, is a critical clue for understanding just how severe a delay might be. And this chart just lays it all out perfectly. When a company blames a corporate event or gives one of those vague, unspecified reasons, the average delay is around 25 days. But when they admit to accounting issues, that delay skyrockets to an average of 40 days. That's more than 2 weeks longer. It tells you right away that not all excuses are created equal, and accounting problems signal some deep, time-consuming trouble. So what does a really serious accounting issue actually sound like in the wild? Well, here's a real example from the study. This company, Gafisa, basically said, hey, we can't file because we have to completely redo last year's financial statements because of errors. And then they dropped this bomb. They said they weren't even in a position to guess when the report would be filed. I mean, yikes. Okay, so we know the kinds of excuses companies give, but let's get to the million-dollar question. Or in this case, the billion-dollar question. How does Wall Street react? It's time to look at the market's verdict, which we can see plain as day in the stock price right after these slips get filed. Now, one thing the research points out is that about 86% of these late filing companies make a promise. They say, don't worry, we'll get the report done within that 15-day grace period. So you have to wonder, does that promise to be on time later actually soften the blow for investors? And the answer from the data is a crystal clear no. The market has an immediate negative reaction to any company that files late. It doesn't matter what they say. On average, their stock price drops 1.66% in just the 5 days around that announcement. The market punishes any sign of a delay, period. And here is the real kicker. It turns out that promise means almost nothing. Look at this. Companies that promise to file on time see their stock drop 1.68%, and the ones that make no promise at all, their stock drops 1.52%. There's basically no statistical difference. Wall Street doesn't care about the promise you make. It just cares that you missed the original deadline. But hold on, because every good investigation has a final twist. And this is where we see the most damage done. And it all comes down to what a company doesn't say. So it turns out the absolute worst thing a company can possibly do is tell the market it's going to be very late and then give absolutely no specific reason why. Let me show you the data because it is truly shocking. Okay, get ready for this because it's wild. We're looking at just the companies that did not promise to meet that grace period. If they cited corporate events, their stock actually went up a bit. If they cited complex accounting issues, same thing, a slight positive bump, probably because investors appreciate the honesty. But if they gave an unspecified reason, their stock got hammered, plummeting an average of 8.78%, an absolutely massive, catastrophic drop. So why on earth does this happen? The researchers call it adverse selection.
Basically, when a company is late and is being deliberately vague, investors do not give them the benefit of the doubt. They assume the absolute worst-case scenario is happening behind closed doors. In the world of finance, silence is most definitely not golden. All right, so we followed all the clues and cracked the case. What does this whole mystery mean for you as an investor? What are the big takeaways here?
Let's just break it all down. First, any delay for any reason is a red flag. Second, if you hear the words accounting issues, you should expect the longest delays. Third, don't be fooled by a promise to be on time later. The market completely ignores it. And the most important lesson of all, vague excuses are the most dangerous signal you can get. Transparency, even when the news is bad, is always better than silence.
Which kind of brings us to our final thought here, and it's really a question for you. After seeing how brutally the market punishes vagueness, if you were the CEO and you knew you were facing an unavoidable delay, what excuse would you give? Would you be specific and risk a long, drawn-out process? Or would you be vague and risk that massive stock drop? It's a tough choice, and it just shows how critical clear communication really is on Wall Street.